Thank you for joining us for the second in a series of webinars discussing the PPP loan forgiveness presented by my dad, Alan Sasrath, one of the founding partners of Sasrath and Zarian LLP.
Thanks, Justin. I'll see you later for dinner. So before we get started, I wanted to introduce our sponsor, Joe Campolo from Campolo Middleton McCormick, CMM, and CMM Strategies. Joe?
Thanks, Alan. And it's a good thing that Justin's mom is good looking. You know, that's where he gets his good looks from. Good kid there. He's growing up so fast, though. I can't believe how fast everybody's growing up. And to the audience, you know, welcome. You know, Alan has truly been working tirelessly at trying to help get the Long Island community through this PPP. I for one, am sick of the three letters PPP. I'm sick of hearing about it. I'm sick of thinking about it. And thank God for Alan Sasrath and his team for really working so hard to understand it and stay on top of the nuances. It's a really important piece of this jigsaw puzzle we're involved in right now to get us to the other side. And I am fully 100% relying on Alan's expertise at this point to get us through it. And I strongly suggest to the business folks out there that you do the same, right? We have to start thinking about life past PPP. We have to start thinking about what that's going to look like. We're all kind of obsessing about PPP right now, but truly every day, all day, I'm in touch with Alan, understanding what he's doing, and him and his world-class team are really on top of this. So pay attention, learn up, and then Long Island, we got to get back to work. And we got to start thinking about life past PPP and getting back to work. So, Alan, thanks again for tirelessly staying on top of this really important piece. And I think everybody really is in for a very educational webinar.
Thanks, Joe. Thanks, Joe. And for those of you that don't know or haven't worked with Joe before, Joe and I have worked on a number of deals together. And I don't know anybody that I want in the room on my side if I'm in a position where we're looking to buy a business or to sell a business. Let's see. So. Jen, quickly, I've gotten a message that says that I'm disabled screen sharing. So if you can get that up, that'd be great. In the meantime, let's see. So I wanted to give a quick overview of what we're going to be doing today. I'm sorry. I was planning to have the PowerPoint up, but we'll get that up in a minute. So in the meantime, like I said, let me just talk through what we're looking at doing today. So the reason that we started doing this, that we're running these webinars, is that what happened when we started this, once our clients started to get funded, we were having the same phone call 10 times a day. So it's sort of taken on a life of its own. For the prior webinar, we created an Excel workbook. We've now updated that workbook. It's not ready to be sent out yet. It will be ready hopefully by Friday of this week to be sent out. But in the meantime, I was going through the list of participants, and I saw we've got a number of clients on this call. We've got some what I'm going to consider potential clients. I saw there are a number of CPAs out there as well, and then there's a number of our contacts too. So like I said, we are we're we're getting ready to, here we go. Now I can share the screen. So, yeah, let's see. So now, all right. Sorry about these technical difficulties. Here we go. Okay. So now let's take a look at again. So now let's go to the overview screen. So as far as the overview goes, so like I said, I mean, the thing about this is that we are so for our clients, we're helping our clients already. For some potential clients, we're helping those as well. And if there's anybody out there that isn't looking to change accountants but needs help with this, feel free to reach out to us, and we'll work out an arrangement. So I just wanted to let everybody know that that's available. You notice that I had my son introduce me. Part of the reason for that is we are constantly getting questions as far as, well, can I hire my family? Can I hire my dog? Can I pay for my PPP? Pay them out of my PPP? All these kind of questions. And to date, the only, not the only, but the one limitation on family is that, and it's not even a limitation on family, it's owner compensation, that owner compensation that you can use for PPP forgiveness is limited to your either the lesser of your 2019 compensation or your current year compensation, and that's limited to the $15,385, which is the $100,000 for 8 weeks. But so now I've got about 150 or 200 witnesses that see that my son's worked for me. So now I feel good that I can include him as part of the PPP forgiveness program. For those of you that know me and know my sarcastic sense of humor, that's half a joke. So we'll see how things work out. The one thing, so moving on, there's still a lot of confusion surrounding the PPP forgiveness. The process seems like it's been cleared up. There's not 100% clarity on everything, and we're going to go through that today, or a number of the items today. But that being said, like I said, we're gonna go through some of the things that are still confusing, and a lot of the things that are clear, so that you'll be able to work with this much better. In the application itself, the last page of the application, the last 2 pages, talks about documentation, and I'm looking at this almost the same way that I look at, say, preparing for information for a bank loan, or preparing information, say, for an IRS audit, maybe more the latter. And normally when we do that sort of thing, you can either over prepare and sort of do the agent's work for them, or you can not do that and almost be a little bit of a pain in the neck to the agent, and different agents react differently. Different people, different presenters present differently. So the thought process with doing their work for them is that if you become their friend and do their work for them, that they'll sort of overlook things potentially. Or the opposite of being a pain in the neck is that they'll want to get rid of you quickly, so that they're not going to want to deal with you, but that also means that they might want to dig in their heels. There's a whole host of things that can happen. So in preparing the document, in preparing the documentation, the question is, do we want to, sort of over prepare it, or under prepare it? And I guess that the way that I normally go into those things is I start out on the side of over preparing, and if I see that the agent's going to be a pain in the neck no matter what, then I might change the way that I do things. But that should be part of the thought process as we're going through this and as we're preparing documentation for this. I mean, the best thing, I would think, is that we're going to sort of prepare everything and give it to them on a silver platter. But with that, with saying that, we're aggressive where we can be. So because there's a lot of gray areas right now, there's a lot that's been cleared up, but there's still some that's gray. The parts that are gray, we still will want to take the position that's best for us. And looking at the way that that guidance has come out on this, the guidance has been, it's been very borrower friendly. I don't know that anybody was really, when we were talking about the certifications a week and a half ago, I don't know that anybody was expecting it to be so borrower friendly. I mean, we still need to document what we do, but at the same time, it came out very borrower friendly. So I think that when we prepare our documents and prepare our support and pay our bills and transfer money from our PPP account, assuming that we have it, to our regular operating account, that we're erring on the side of aggressiveness. And that's what, and when I say that, I don't mean if something's black and something's black or white, we're not gonna do something that's completely wrong. But at this, like I said, at the same time, if there's some gray in there, we will, I think what we all should be doing is taking that position. So when the application came out last Friday. The application is 11 pages long, and the application, the main application, you've got the application itself and line by line instructions and the summary overview. That takes up 3 of the 11 pages. There's a certification as well, again, where you're talking about where you're certifying that everything that you've given them is accurate and in accordance with their guidelines. So there's a 1-page certification. With regards to payroll costs, non-payroll costs, mainly payroll costs. So payroll costs, including the full-time equivalent reduction and the wage reduction, that's 5 of the 11 pages. So that's 5 of the 11 pages. That's where we're going to spend a lot of our time today. And then there's a page on documentation, and then there's a page on demographics as well if you want to complete that. So, our previous webinar, what we did was we went through the PowerPoint, and then we went through the workbook, and then we went through an example in the workbook. This time, we're going to go through the PowerPoint and the workbook with an example, just because there's a lot of data that is needed for this application, and it's as you'll see, it's very data heavy. What we tried to do with the PowerPoint is we tried to make this a working or more of a reference document where we hit the high points and where the source of a lot of the questions are. So after the webinar, we're going to send the PowerPoint and the replay out via link. And then, like I said, later in the week, or the worst case would be Tuesday, we're going to send out the workbook as well. We're going to look at a copy of the workbook today. It's just hasn't been tested enough for us to feel comfortable to send it out to everybody. So, but we'll get there. We're almost there. And as you'll see, there's a lot in there. So we'll get there. So now we're going to go through. So now we're going to go through the forgiveness calculation. So at a very high level, forgiveness calculation, that hasn't changed. You've got your payroll and non-payroll costs for 8 weeks. You've got your you've got a salary or wage or hourly wage reduction, which we'll go into more in a little bit. You've got the full-time equivalent reduction. Then you've got the payroll costs, the 75% limitation, and then you come down to your forgiveness amount. Seems easy. We'll see where the where the glitches come in. So the first thing to note is that for payroll costs, there was confusion as far as whether payroll costs, whether it was whether it needed to be incurred and paid during the period, as the original rule said. In the instructions clearly states that eligible payroll costs incurred or paid during the covered period or alternative payroll covered period. And we'll talk about what the covered period and the alternative covered period is as well. But now it's costs incurred or paid. So what that means is that if you received your funding on April 29th and you have a semi-monthly payroll and you have your payroll on April 30th, you can include the entire April 30th payroll, because that's paid within your within the covered period, assuming that's what you elect. And then you're going to have your normal payroll periods for the next. You've got April 30th, then you're going to have May 15th, you're going to have May 31st, and then you've got June 15th. The following period is going to fall outside. However, the incurred piece of that is between June 16th and June 23rd. There's payroll there as well. And as long as that payroll is paid on June 30th in the normal course of your business, then you can include that as well. So so in essence, what's happening is that you're allowed to include more than 8 weeks of payroll. For your employees that make more than $100,000 a year, or for employees, any employee, you're still limited to the 15,385, which is 100,000 divided by 52 times 8, because it's an 8-week period. You're still limited there. But like I said, you're in essence, you're grabbing more than 8 weeks of payroll. So the covered period is the 8 weeks that runs from the date that you receive your funding, and your funding is the first day of that period. It's not the day after, it's that day. That's the first day of your 8-week or 56-day period. You can elect to use the alternative payroll covered period, which is available only to borrowers who have a biweekly or more frequent payroll schedule. So it's not available to semi-monthly, it's not available to monthly. And what that means is that rather than starting on the day that you received your funds, it starts on the first day of the first pay period following the day that you get those funds. So in my example, if April 30th was the pay date and it was the biweekly pay period, then you would be shooting yourself in the foot to say, we want to start our payroll on May 1st. It might be, well, let me finish that thought. Because now you're losing the April 30th and previous period that you had by using the covered period. So this was done, I think it was done to I don't know if it was done to keep accountants happy, or what the story is, but I guess the times where that might make sense is if you need a week or two, or a week, if you're biweekly and you need 2 weeks to bring everybody back to get them on payroll because you're able to start up, then maybe it makes sense to hold off and do the alternative payroll covered period. But for the most part, it appears that the covered period is going to be a better answer, but again, you need to look at your own specific situation, and and with the help of a professional, figure out which is best for you. So that's the payroll costs, and so again, so as far as the payroll costs, there were a number of key points, or a number of items that came out with more clarity than we previously had. So I just want to go through some of them. So payroll costs, they're considered paid on the day that the paychecks are distributed, or the borrower initiates an ACH transaction. So that's first. You're only allowed to count payroll costs that are both paid and incurred in the covered period, or the alternative payroll covered period. You're only allowed to consider them once. I was put there for, I guess, the cute accountants and attorneys that are out there that would want to, tax accountants, tax attorneys that would want to argue that it could be included more than once. Since it includes all payroll paid, it appears that if there was any unpaid payroll from prior periods, that we'd be able to include that, again, as long as it was paid in the covered period or the APCP. Either one, you'd be able to get, it looks like you'd be able to get that. There's no limitation on how far you can go back. I mean, Department of Labor might have something to say about that, but in any event, that's something else that can be done. It includes payroll costs incurred in the last pay period of the covered period, or APCP, as long as they are paid no later than the next regular payroll date. That's what I mentioned on the previous slide. So if you have a stub period and your payroll ends on, or your period ends on June 23rd, your payroll's on June 30th, you're allowed to accrue the payroll and count that as long as it's paid by June 30th. If you choose the alternative period, covered period, the APCP, then you've got to use that period for health insurance, retirement plan contributions, and state and local income taxes. Those are that were assessed on employee compensation. Non-payroll costs are still based on the covered period. Non-payroll costs are still based on the 8 weeks from the date that you're funded. Okay, now, paid or incurred, paid and incurred, and paid, because there's still some confusion in the instructions in that. So if you have the application, if you don't have the application out, it might be not a bad idea to print it out, because I'm going to refer back to it. But so on page 1 at the bottom, line 1 instructions talks about eligible payroll costs incurred or paid. So that's the incurred or paid, and that's prevalent on that first page. On page 2, in the lower half of the page, talks about eligible payroll costs paid and eligible payroll costs incurred. That phrasing seems to piggyback a little off of the original wording. However, it's easily read that, or I mean, I guess it could be read a number of different ways, but the way that I'm reading it, or I'm choosing to read it, is that where it says paid or incurred, you don't have to choose whether you're going to use the paid method or the incurred method. It's paid and incurred. So if it's paid, then we get to take that, and if it's incurred, we get to take that. Again, that's how I'm reading it. That's how I've seen it read in a number of other situations. So, and again, I mean, that sort of goes with my aggressive position, but again, that's what that's the way that I'm reading it. And then if you look at page 5 on the Schedule A instructions, there's three main worksheets to prepare when you're doing this form. There's the main application, there's Schedule A, and then there's a worksheet to Schedule A, which we've mimicked in our Excel file, and that we'll get to. But so in any event, for the Schedule A instructions, line 6 to 8 talks about health, retirement, and state taxes paid. Doesn't say paid or incurred. And paid is actually underlined where it talks about the state taxes. So for that reason, we're suggesting that you make sure that your health, retirement, and state taxes that you plan on getting forgiven is paid. And then we're hoping that we go back to that page 1 wording where it's paid or incurred, so that if there's a piece that we haven't paid yet, that we can take that as well. As far as health insurance and retirement plans, talks about employees only. In the interim final ruling, there's an example where it says self-employed forgiveness, that it's employees only, not owners. It talks about employees everywhere. It doesn't say for an S corp that the employee owners don't get that treatment. Again, this is another question that we're still waiting to, I guess, to hear more on, or not to hear more on, and we're going to take it. So, but if that's the case, then it's going to leave the independent contractors, proprietors, and partners out in the cold, because there it was, for self-employed, it was clear that it's employees, not owners. Doesn't make any sense. However, just like tax law doesn't need to make sense. Anything that the government sends out as law, it doesn't need to make sense. It's just the law. That's what it is. And then number 8, as I mentioned earlier, owner employees are limited to $15,385 or the 8-week equivalent of their applicable compensation for 2019, whichever, or their compensation during 2020, whichever is lower. So again, if you're an owner or employee owner and you had a $36,000 salary in 2019 and you bumped up your salary for this purpose, that's not going to work. There's nothing that says that you can't pay family members. It would probably be easy for them to put that in, but that's not there right now. So keep that in mind. And then the $15,385 per employee cap, that's the cap for the covered period in the APCP. There's no reference to a per pay period cap. It's not $19.23 a week. It's $15,385 for the 8-week period. So that's payroll costs. As far as non-payroll costs go, so the expenses, again, expenses that are paid during the covered period or incurred during the covered period and paid by the next regular due date, even if it's outside the covered period, are the costs that are included. So again, you're accruing up until the end of your covered period for the last payment, which could go outside the covered period. And this includes mortgage interest on obligations incurred before February 15, 2020 on real or personal property. So if you have a loan on your car, you can take that interest expense as well, or on a truck, or on another piece of equipment, you're allowed to take that interest expense. As far as business rent or lease payments, it's again for real and personal property on leases that were in force before February 15th, 2020. And once again, not just real property, but your copier lease, your auto lease, all that's included as well. And then with regards to utilities, we've got the, again, it's the same definition: electricity, gas, water, transportation. Transportation, again, in the interim final ruling, they talk about gasoline, telephone, internet, and internet access. Again, for where the service had started prior to February 15th. So now, so as I mentioned, we have the full-time equivalent reduction. So once we figure out, so we just did the first piece. We said, all right, so we paid these payroll expenses, we paid these non-payroll expenses. Now we have to figure out what the reductions are. Again, there are reductions for full-time equivalent. There are reductions for wages if we reduce salaries below a certain threshold for certain employees, and we have the 75-25%, the reduction as well. So, and again, so what I'm going to do is I'm going to go through this here, and we're going to take a closer look in the Excel workbook. It's so with regards to the full-time equivalent reduction, we look at the full-time equivalents that we have for the covered period or the APCP, and the way that we look at that, so we say it's the full-time equivalents are determined on an employee by employee basis. They made that clear to make everybody's life really miserable. And then for non-salaried employees, it's based on a 40-hour work week and rounded to the nearest tenth. So if somebody works 30 hours, 30 divided by 40 is 0.75. We round that to 0.8. Salary employees are considered one full-time equivalent. And there's a simplified method if you don't want to go through all the calculations, where you use 1.0 for all salaried, and you use 0.5 for all employees that work less than 40 hours. And so once you calculate that for your either the covered period or either the CP or the APCP, then you need to compare that to the base period. Base period is either February 15th, 2019 through June 30, 2019, or 1/1/2020 through 2/29/2020. Those are, and that's at your option. So the lower of those two, that's what you're going to compare it to, and you use again, you use the average. And then for the safe harbor that we'll talk about later, you need some other periods. You need to figure out the full-time equivalents that you had on February 15th, 2020, for the period February 15th through April 26th, 2020, and for June 30, 2020. Again, to figure out that's for the safe harbor and reduction calculations. And again, I'm running through this quickly so that we can get to the workbook. I'm not expecting everyone to catch everything, but I think that by this time most have some sort of a base. So, and then what we have is, so when you have a reduction in the full-time equivalent, there are exceptions to those reductions, so you can add back when you do have a reduction in certain cases, and there's a safe harbor that if you meet the safe harbor, then you can, again, then you don't need to reduce. So what ends up happening, so what we've done on this screen and the other safe harbor screen is, if you just purely look in the instructions, all they have you doing is filling in numbers and saying, so if you go to step 1, put this number in here, this number in here, this number in here. You look at which is greater, then you go to the next step, and they have 4 or 5 steps for each of these processes. So what we tried to do here is just sort of put it into words what they're actually getting at in those steps, at least for the safe harbors. So for the FTE reduction exceptions, so here's where you don't have to count a reduction full time in the FTE calculation against you. So if you have a position where you made a good faith written offer to rehire the employee during the covered period or APCP, which was rejected by the employee, then you don't have to count that as a lost full-time equivalent, and you can add their whatever they were. If they were a full-time employee, 1.0. If they were part-time, they were 0.7, then you can add that 0.7 back. Also, if you have somebody that was fired for cause, that voluntarily resigned, or that voluntarily requested a reduction in their hours, you don't have to use that against the FTE reduction as well. So those are all positives. And then, and again, this is where I was talking about before when I said, as they've come out with more guidance, the guidance has typically been more borrower friendly than not. So this is another case of that. With regards to the FTE reduction safe harbor, so you have to go through a couple of steps. The first is if your FTEs as of February 15th were higher than the period February 15th through April 26th, and you restored that deficiency or that reduction with your June 30th payroll period, then again, if you had a reduction in FTEs, in the FTE, then you don't have to treat that person, or in total, you don't have to treat that as a reduction. And like I said, we're going to go through this in the workbook as well. So that was one. The other big one is the salary and hourly wage reduction. So you need to look at a full-time person's salary or a part-time person average hourly wages. That's where the calculation is done. And this applies to employees who, during any single pay period during 2019, had wages or salaries at an annualized rate of less than or equal to $100,000. So even if they only made $90,000, if part of that $90,000 was a bonus, or they worked overtime and had a big pay and had a big week or month or however they're paid, if during any pay period they had annualized wages equal less than over $100,000, they would not go into this calculation. So only if they didn't have less than an annualized rate at any point in 2019, any pay period 2019, less than or equal to $100,000. So that's the first test. The second thing is that if they have a reduction of more than 25% of either the total salary or average wages during the covered period or APCP when compared to the first quarter of 2020, then that's when you need to look at this. And it's the excess of that 25% that ends up getting added back. So you look at it on an annualized basis, and then you take 8/52 of it to figure out how much your forgiveness amount needs to be reduced. And I'm sorry, I was just stumbling because as I'm reading this, it just seems pretty ridiculous, some of these calculations. And the fact that this has to be done on an employee by employee basis, I got to figure that I'm not the only one that feels that way. So in any event, so now we've got, and then again, because of the safe harbors, we need to calculate their average salary, not just for the covered period or the APCP. We also need it as of 2/15/20 for the period 2/15/20 through 4/26/20 and through the first quarter of 2020 as well. So, and again, there's a safe harbor calculation here, where if you meet the safe harbor, you don't have to reduce your forgiveness amount, and you can continue. Again, where you don't have to reduce the forgiveness amount. So the safe harbor, we've got the so here, this one is much more confusing, believe it or not. So if an employee that was either not employed by the borrower or earned less than $100,000 for all pay periods in 2019. So if you hired them in 2020 and they're going to earn more than $100,000, they fall into this calculation, at least the way that it's set up now. Again, I'm not sure if that's exactly what they meant, but that's what they've done. So in any event, because of that, those are the cards we have to play. And then so then what happens is it's an employee in that category whose average annual salary or hourly wages were reduced by more than 25% during the covered period or APCP when compared to the first quarter, and whose average annual salary or hourly wages as of February 15th or higher than their average annual salary or hourly wages during the period February 15th through April 26th, and whose average annual salary or hourly wages as of June 30th were restored. Then if they meet all those, they check all those boxes, then the safe harbor applies and you don't have to reduce your forgiveness amount because of this. So so again, that's more, again, once we get into the workbook, which it looks like that's where we're at right now. Let me pull that up. So we've got the workbook. We're going to get the workbook up. Let's see. Okay. So here we have the workbook. Okay. And this is, so we tried to make this as similar as to the prior workbook that we had, but the reality is that there are a lot of differences. And because there are a lot of differences, we are mimicking the actual application. So in the app, so first we have this is the same introduction that was with our other workbook. We've got the instructions, we've got the document list, and then so this is the actual application, or copy of the actual application, where all of the data that we put into this workbook is going to flow to. This is the application. This is the Schedule A that I had mentioned earlier, and this is the Schedule A worksheet. And the way that this worksheet works is that, so here we have Table 1 and Table 2, which is the data which is coming from our data, data workbooks. And what happens in our data is that the more employees that we put into our workbook, the more employees are going to populate our Table 1 and Table 2. Table 1 are the employees that earned less than $100,000 in 2019 or didn't work for us in 2019. Table 2 are the people that earned more than $100,000 in any period in 2019. And this will populate as well. We were concentrating more on this. And as I said, as more employees are added on our forgiveness tab and our payroll. On that? Say it again. Okay. All right. All right. So now I should be sharing the worksheet. So the worksheet, let's see. All right. So now, so this part of the worksheet is very similar to the prior workbook, where here we're going to input our health insurance, state and local taxes, 401k match, the pension plan, everything that we paid, plus the non-payroll expenses. That's what gets input during the 8 periods, and we'll so this is what's input here. We'll increase these to account for additional periods, because as we talked about with the covered period and non-covered period, but and then the two main worksheets where we do most of our input. We have the payroll reduction worksheet, which once we populate line 6 with names, this goes all the way across with just the word name in there. But once that gets populated with names, then this will flow to the Schedule A worksheet as well. So here, just running down again, the beige areas are the areas that we need to put data into. So here, so for Fred, we have their name, we have their identifier, which is last 4 digits of their social security number. If they earned over $100,000 based on that formula that I mentioned during any period during 2019, then we put a yes in there. If we put a yes in there, then it goes right to that to table 2 on worksheet A, goes right in here. The then for the periods during the covered period or APCP, we put the amounts that they earned. We also have to put, before we go there, we have to put whether they're, use the drop down to say whether they're an hourly or salaried employee. For an hourly employee, again, we put the totals, we put the total numbers in. We everything again in the white area is calculated. The average rate is calculated because on the full-time equivalent worksheet, we put in the total number of hours. We'll get there in a second. But and here's where the calculations are done to see whether or not their wages, whether their salaries or hourly wages were reduced by more than the 25%. So because Fred earned over $100,000, we don't need to do that calculation for Fred. So everything's blacked out. For an hourly person, for Joe, who didn't earn more than $100,000 in 2019, we do need to do that calculation. And down here, based on the information that we put in for their hourly wage as of February 15th, period between February 15th and April 26th, and as of June 30th, it gets whether the safe harbor was met gets calculated automatically. And down here, as we mentioned, if they have either a voluntary reduction of hours, resigned for cause, that again, because they didn't, that too would also forego the calculation. So like I said, that's not going to get held against us. So for the again, so again, here we need to put in type of employee, whether they're hourly or salary, whether they made more than $100,000 or not, their payroll during the pay periods, and to calculate the payroll reduction here. So for John and for George, there is a payroll reduction calculation. However, for John, his wages were reduced and stayed low, and because of that, there's a salary reduction that gets calculated into the formula. For George, his wages were raised back up to where they were on February 15th. So because of that, we meet the safe harbor, and there is no reduction for his wages. Now, so again, that's the payroll reduction calculation. On the full-time equivalent calculation, again, so here the names, the identifier, and whether they're hourly or salary flowed through. We have to say whether we're using the simplified calculation or not. If we're using the simplified calculation, all part-timers are 0.5 hours, all full-timers are 1 hour, I'm sorry, 1 FTE versus 0.5 FTEs. And we have to put in what our pay period is, whether it's weekly, biweekly, semi-monthly, so that when we put the number of hours in, so for here, what we need to do for each of the hourly employees, we need to put the hours in for the base period, February 15th through June 30, 2019, or January 1st through February 29th, 2020. We need to put them both in, and then the program will compute what's best for us to calculate to calculate whether or not there's an FTE reduction or not. So based on the hours that are in here, there's there is a reduction factor, and the way that this flows to the actual schedules. So now what happens is once you populate this with your information, again, for salaried employees, we're not putting in hours, we're just putting in whether they were employed during this time period or not. So once we have all of the data, what's going to happen is first the Schedule A worksheet is going to populate, which is going to show us employee by employee their compensation, their hourly reduction, and what their full-time equivalent is. On Schedule A, so this is Schedule A of the workbook that summarizes a lot of the payroll data. Here, you're also going to input the well, actually, this is going to flow from the forgiveness data sheet, the owner's compensation, because on Table 1 and Table 2, Table 1 is people that made less than 100,000 who are not owner employees. Table 2 is people that made 100,000 or more in 2019 who are not owner employees, and then the owner employees are the information comes from here. So again, just bringing this back to Schedule A, this is the health insurance, and then these are the numbers that get populated on the application, so that the application, we have our payroll costs are summarized, our rental lease payments are summarized, our utilities are summarized, and then we have our salary or wage reduction. We have, to come down to the amounts that can potentially be forgiven. Then we have another reduction because of the full-time equivalents are reduced. So total that we can get forgiven based on what we paid is $95,000. The amount of our loan was $90,000. The limitation due to the fact that it's only 75% of our forgiveness needs to be payroll, so it comes down to $84,000. So in this example, we're only able to forgive $84,000, and I'm going to apologize in advance for running through that, but there's a lot of data that goes into this, and once we provide the workbook, what we're going to do is we're going to provide the workbook. We're going to provide this example where we're going to have all of the data that goes into this example, and then we're going to include a sample workbook as well, so that you can see how it goes from, first you're going to see the data that you need, then you're going to see how it flows into the workbook and the result, and then you're going to come up with your own data workbook. Hopefully the payroll companies are going to help with this, but we'll see where that goes. Like I said, I mean, the payroll companies can be a godsend for us. So now, so we've got the HEROES Act, which was signed May 15th by the House of Representatives. That is not law, and these are some of the provisions in there. Some of the highlights: it extends the 8-week period for the covered period, or the APCP to the from 8 weeks to 24 weeks. Extends the minimum maturity on the loan to 5 years from 2 years, and repeals the requirement for 75%. It looks like we have a couple of minutes for self-employed and questions. George, let's get George back on here. He was going to talk about the self-employeds. So George, you want to talk about the self-employeds quickly, and maybe run through a couple of questions, because we're running up against our time limit right now.
I just quickly want to go over self-employed. So for self-employed people, it's strictly based on your 2019 Schedule C income. Basically, the calculation is you take your 2019 bottom line net income on your Schedule C, and you divide that by 52 times 8 to get 8/52 of what your Schedule C income, and that's what your forgiveness is considered. On top of that, you're also entitled to the utilities, rent, any interest payments as well, just like any business would be entitled to. Plus, if you have employees, the same calculation for the employees. The one thing right now, the way the rules are reading, you're not allowed to include any of health insurance or pension payments for self-employed individuals. Fortunately, that's how they have it written. We're hoping there'll be some more corrections on that, but at the moment you can't include that. One major question that we keep getting from a lot of self-employed individuals is whether they're allowed to take the PPP loan money and collect unemployment insurance after they've gotten the money. Based on the guidance from the SBA so far, it says once you receive the PPP money, you most likely are not entitled to collect unemployment insurance any longer. So our recommendation would be, if you get the PPP money, you'd have to either decide whether unemployments were beneficial and return the PPP funds, or if you keep the PPP funds, cancel your unemployment at that moment, since the PPP is considered earnings to you. It's replacement of your payroll, basically. Some additional questions we keep getting. Let's see.
Now, George, I think we have time for one more question. Unfortunately, it's been...
Okay, so basically one of the main questions that we keep getting is the payroll. Basically, if you got the money today and your payroll period ends tomorrow, you make the payroll payment tomorrow, that's fully included in the payroll calculation, in the forgiveness calculation, based on the new guidance that we've received from the SBA. It's paid or incurred, so if you pay it during this time period, you can forgive it. Additionally, any other questions that we've gotten through the question and answers, or if you have any questions, email us. We'll respond to everyone that we've gotten questions from so far.
All right. Thanks, everybody. Thanks for attending.
Thank you.
I hope you found this informative. Like I said, there's a lot of information here. and feel free to reach out to us for help. Thank you.